Hi everybody, in this video we're going to focus on the pros and cons of being part of a monetary union. Remember what a monetary union is? It's when nations join together and form a trading bloc where they agree to trade freely between themselves, to adopt common external barriers against non-member nations, the imports coming in from those countries, to allow for free movement of labour, of capital, businesses, but also to adopt the same currency, to adopt the same central bank, and to adopt the same monetary policy. Those three features are distinct features of monetary union. Okay? So, a good example is of the Eurozone. So all Eurozone nations, 17 of them, have agreed to adopt the euro as their single currency. With that comes the European Central Bank, one governing kind of central bank, and one monetary policy that the bankers within the European Central Bank actually set. Let's look at the pros and cons of being part of such a monetary union. We'll look at it in terms of the UK. So if the UK was looking to join the Eurozone, which it isn't, but hypothetically, if it was, what would be the reasons behind that move? Well, being part of a non-fluctuating exchange rate. This applies for smaller nations, really, who have got exchange rates that are quite soft and exchange rates that are quite volatile. So by coming into the euro and adopting a much more stable currency, a currency where foreign investors have got far more confidence in it to hold its value, to reflect purchasing power parity, then there is a greater chance of more stability in a nation, of greater business confidence, of greater investment, and especially of greater international trade. It becomes much easier to trade, to export and to import with other nations if other nations can trust that your currency is going to hold its value. That's a huge benefit, the trade benefits that come from a non-fluctuating exchange rate. Then number two is a big one, reduced costs that come from currency conversion. So for consumers it's good because they're going to have more money in their pockets to buy European goods and services that all have the same currency, the euro. They don't need to convert their currency. So in that sense they save. Businesses save too, again, coming back to trade. If countries want to trade between each other within Europe, if countries have the same currency, then you get rid of the cost of converting. That's a substantial saving. And that money could be used for investment purposes. It can be used for all sorts of different reasons, for all sorts of good reasons. Business confidence improves again. You can expect greater investment if your currency is more stable. You can plan for the future if you're an exporting firm. If you have to import certain raw materials for production-based purposes, then again you can predict what the prices are going to be, knowing that your currency is not going to fluctuate too much. And it makes future planning far easier. It makes planning investment decisions much easier as well. Your currency is unlikely to be prone to speculative attacks. Again, as the confidence is there for foreign investors, it's unlikely that your currency is going to be over or undervalued. In that sense, less prone to speculation. And for consumers and for businesses too, it's easier to compare prices between member nations, which again is a very useful thing, especially if you've got very small countries with easier to cross borders. It's very easy to compare prices instead of always having to think about different currencies and having to exchange. What are the issues though? There are some big reasons why the UK, for example, does not want to be part of the Eurozone. I would argue number one is the key reason why. As soon as you join the Eurozone, as soon as you decide to be part of a single currency and you adopt the same central bank as everybody else within that trading bloc, you lose all control you have over monetary policy. All your autonomy over monetary policy goes towards that one governing central bank. And that's a problem because if you have a differing set of economic circumstances than most of the other nations in that trading bloc, there is no guarantee that the monetary policy set is going to be suitable for you as a nation. Take the UK for example. So the UK prior to the 2008 great financial crash was actually booming. It was in quite a healthy position, yet the ECB kept interest rates very low in that period of time. So if the UK was part of the Eurozone then, it might have suffered from unnecessary bubbles in the economy, credit-based bubbles in the economy. That came from very low interest rates. And that would not have been a very suitable policy for the UK in that moment. So losing that monetary policy autonomy is huge. It's not just interest rate setting, you also lose the control over printing money. The UK would not have been able to adopt quantitative easing as a policy so quickly if it was part of the Eurozone. So losing these key controls is a big, big, big loss. Huge loss. Biggest argument why the UK doesn't want to be part of the Eurozone. This is quite a big argument. This kind of comes back to monetary policy again, with the third strand of it. Without your own currency and your own exchange rate, there is no potential for you to alter your exchange rate to boost your trade performance. So if you were in dire straits or were in need of export-based growth, then you could artificially depreciate your currency if you had your own currency and your own exchange rate, right? But if you are part of the single currency, you have no control to do that. So if you wanted a boost in trade performance, you've got to look elsewhere. You can't rely on a fall in the value of your currency to get you there because you have no control over it. The cost of currency conversion is very, very high. So taking out one currency from the market, getting rid of it, and adopting a new one is a very costly process. The physical cost of printing the new notes and coins and getting it out in circulation, the cost of taking away all the old notes and coins from the economy, the cost of reprinting menus and setting up new databases, all of these things are very costly, and that needs to be in the forefront of politicians' mind before they decide to say yes to being part of a monetary union. And number four, this is an argument that's come very much true within the Eurozone in the past kind of 6-7 years. If you don't have a fiscal union to go with your monetary union, then you could have countries who are free to adopt their own fiscal policies, but if they're reckless with those fiscal policies, it could destabilise the entire union. We've seen that happen with Greece, with Portugal, with Spain, with Ireland, all these kind of countries, Italy, have had to adopt strict austerity measures recently because they've been so reckless with their fiscal policy, overspending and very inefficient with tax collection. And the threat of that could be that a country may have to leave the euro because they're not able to meet the given criteria to stay within it. They may actually even go bankrupt and cause a run on the currency or something like that. Why is that a problem? Well, it acts as a major burden on other nations within the Eurozone. So if that happens, if nations end up kind of losing control over their fiscal policy and overspending, getting into massive debt problems as a result of it, it could come down on other major nations. And if the euro does kind of go into collapse and there is a run on the euro, it's other major nations like Germany, like France, that have to bail out these countries, that have to suffer the cost as a result of it. So a lack of a fiscal union could lead to a destabilisation of the entire trading bloc if countries are very reckless with their fiscal policy. So this is a really useful little video for you to take away and to write these points down because, again, exam questions on this are very common. Very simple points. These are always going to be the points you need. Just make sure you can analyse them well, you can evaluate well, and you'll be set for your exam. Thanks for watching, guys. See you next time.